You will lose your ability to deduct interest against your rental property or business unless you follow very specific steps. Say you take out a home equity line of credit, or HELOC for short, to buy a rental property or to start a business. You are going to pay interest on that HELOC. Wouldn't it be nice to be able to deduct that interest? Good news is that you can if you can show that you used the loan to start a business, purchase real estate, and possibly, if you purchased stock with it, you can deduct that interest too. This is because of the interest tracing rule. The interest tracing rule says that whether or not you can deduct interest on a loan depends on what you use the loan for. If you use the loan for personal purposes like a trip, buying yourself a new car, or other personal reasons, then it is not deductible. But if you used it for a potentially money-making venture like a business or rental property, then you can deduct. However, you need to be able to show with bank statements and traceable money movements that the specific loan funds were used to purchase that rental property or that business. In a perfect world, if you plan to use the HELOC funds to purchase a rental, the funds would be deposited to an account with zero other transactional activity. And then the only other transaction would be the real estate purchase or investment into the business. So in both these scenarios, whether you're using the HELOC for a rental or for business, there would be direct and obvious proof that the loan was used for a specific purpose. The interest could then be deducted against your business revenue or rental income. But the world is not perfect. Often, the HELOC funds will be deposited into your personal account. Your personal account typically has lots of different transactions coming in and out. Your paycheck and gifts from your sugar daddy or your rich uncle come in. Payments for rent, insurance, credit cards, and your STD medication, those go out of the account. If the HELOC funds are deposited in this account and then sit there for a few days or weeks, the loan has been commingled with your personal funds, and it becomes much harder, if not impossible, to be able to trace the use of the loan proceeds. Here's the solution. If the HELOC funds will be placed in your personal account that has other transactions in it, immediately move those funds to an account with not other anticipated transactions. Keep the funds there until you are ready to purchase the real estate or inject the funds into the business. This allows you to show exactly what those funds were used for in the event your interest deduction is audited. Now, for a lifesaver when things don't go perfectly, what if you realize you made an investment purchase just a few days before your loan money came in? Well, the IRS gives you a special safe harbor called the 30-day rule. The rule: any capital expenditure you make from a commingled account within 30 days before or 30 days after the loan proceeds are deposited can still be treated as being made from those loan proceeds. That was a lot. Here's an example. You pull $20,000 from your messy checking account to buy a block of investment stocks. 15 days later, your HELOC funds deposit into that same account. Under the 30-day rule, you can elect to treat that $20,000 stock purchase as funded by the HELOC, making the interest deductible as investment interest. Use this rule if you have to, but always try for the clean account method first. Deducting investment interest. Let's switch gears and discuss deducting investment interest. What if you use the loan to buy stocks or bonds? This is called investment interest expense, and it has a major limitation. You can only deduct investment interest up to the amount of your net investment income for the year. Here's an example. If you paid $5,000 in interest on the loan, but only received $3,000 in investment income like dividends or interest, you can only deduct $3,000 this year. The remaining $2,000 is carried forward indefinitely to next year, where you can deduct it against future investment income. This is reported on Form 4952. Let's talk about a common cash out refi mistake. Perhaps the most common mistake. The assumption that a loan secured by your home is always deductible. You cannot buy a home with cash and then later take out a mortgage used for something else, hoping to deduct the interest simply because the loan is secured by your home. The loan proceeds must be used to acquire or improve that specific home to be deductible as home acquisition debt interest. Here's an example. Chris and Christina each buy a brand new home that they use as their primary residence. Chris pays $500K cash for the new home and then immediately applies for and receives a $200,000 cash out refi. Christina buys a $500,000 home by putting $300K down and taking out a $200K mortgage. At the end of the year, they both appear to be in the exact same place. They own a $500,000 house and owe $200,000 on it. However, only Christina can deduct the loan interest. Why? Because Chris did not use the $200K to acquire or improve his property. If you cash out your personal residence to buy a rental, you can deduct the interest, but only if you follow the interest tracing rule perfectly. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.